Hi, Matt. The U.S. tariff regime is top of mind for most everyone, and while I recognize that it's a bit premature to evaluate its full impact, to what extent are we seeing a change in companies' earnings expectations? And in your discussions with management teams, what's been their overall response to the tariff situation?
So the overall response is one of obviously surprise, consternation, concern. And we see a range of different responses across different industry groups. But the first thing I'll say is that it is too early to know for sure. What we have seen at a top-down level is earnings expectations have moderated a few percent for the S&P 500. But the softer sentiment surveys have weakened further, whether it's consumer expectations or the National Association of Purchasing Managers survey, they've weakened more. And so companies are responding to a range of different concerns. One is that supply chains that have been built over decades have come into question. And that's a more structural question mark for companies. The second is that this is a de facto fiscal tightening. It's like a consumption tax, backdoor consumption tax. And so people are worried about the demand impact. But the reality is people are feeling in the dark. They don't know what the ultimate tariffs will be, and they don't know to what extent trade will resume with China and the United States. And so there are a whole host of unknowns. But at the margin, we've seen expectations soften.
Now, in light of growing concerns, there have been strong reversals in equity markets out of U.S. stocks and into non-U.S. stocks. And there's also been a rotation into more defensive sectors. So what does this mean for our portfolios?
So what it's meant for our portfolios is that we've been resilient in the face of this uncertainty. And if you rewind in time to where we were at the beginning of the year, markets weren't pricing much in the way of uncertainty. We had the Trump bump before the Trump slump. And so we, in that environment where markets were quite ebullient, had favored, as you suggested, pockets of valuation that were lower, whether it was international securities, whether it was areas like consumer staples, or our potential hedge in gold. All of those things helped us as uncertainty crept into pricing. So as credit spreads went up and equity multiples came down and the dollar weakened, we had a degree of resilience relative to the turmoil that was existing within markets. And hopefully that is what you'd expect from a First Eagle portfolio, that we're going to go where the margin of safety is. And that means that we tend to have our best relative returns when markets are softer overall.
Thank you, Matt. As always, it was great to hear from you.
Thank you.